Hello.
Hi.
Can you
Hi,
hear me?
Ed.
Can you? Hi there. Hey Jay. Hi everybody. Well, look, just very briefly to say thank you to everybody for joining this event, this webinar and information exchange looking at fixed next generation. And I'm going to hand over to Jay, but also just to mention that we hope to carry on these sorts of initiatives into 2026. So very much see this as an initial kickoff for future discussion. So over to you, Jay, and thank you very much indeed to everybody.
Thanks, Ed. I'm Jay Hurley. I'm the head of EFX APAC at State Street, and I'm also the co-chair of the Fixed Income Currency Fixed Committee alongside Vincent Grandjean, who is based in London, who is the founder and CEO of Propellant Digital. The genesis for this webinar is a document published in September by the SFC and HKMA entitled A Roadmap for the Development of Fixed Income and Currency Markets. I feel that fixed income and currencies is not discussed enough from an APAC point of view. So we've gathered three leading figures, all based in Hong Kong, who join me in the room today to discuss the current state of fixed markets from the perspective of what's happened already in the US and EMEA, and turn the lens towards APAC and Hong Kong. So I'd like to introduce Harry Street, who is the global head of credit electronic trading at Bloomberg. Philip Sterner, co-head Asia sales at Tradeweb, and Su Chin Tan, head of FX sales APAC at London Stock Exchange Group. Thank you for coming and joining me this afternoon. So just for attendees, you can use the chat function to ask us questions at any time. Otherwise, we'll try and leave some time at the end where people can raise their hand and ask questions. So I think let's just dive straight in with the first question. And Harry, if you don't mind to start with you. Investors are already using your platform for price discovery for liquid credit products in EMEA and US. I wonder if you could just talk a little bit about this and the challenges that there are in APAC and Hong Kong.
Yeah, sure. So thanks for the introduction, Jay. Thanks for having me today. I suppose when we look at DM credit, be that USIG or Euro products, what we see in terms of the way our market participants are looking at availability of data and pricing. Broadly, I kind of think about it in three different layers. So there is dealer pricing that's available in terms of indicative levels, sometimes firm pricing, and it's a very axe-driven market on the credit side. In addition to that, there are evaluated or composite pricing sources, which are incredibly a valuable piece of the workflow. And then it's how you embed analytics on top of those prices that are available. So those are the three areas. On the platform side, what is really important is how you aggregate that data, how you integrate it into decision support tools to help inform traders of decisions either pre-trade or at trade, and then also integrate that data into other systems. That's a crucial part, and clearly FICC plays a really important role in that. So that's on the DM credit side, which is obviously traded out of APAC as well. When you look at Asia credit and so less liquid products, the same mechanisms exist. It's just that the data is more fragmented. The market is more heterogeneous. You have different currency regions, and often activity can be concentrated in a fewer number of tickers at any given time. So that, coupled with the fact that there is less systematic post-trade reporting, when we consider things like trace and MiFID reporting, the composites that exist have to work even harder of observable data to provide value back to customers. So what we're seeing on our side is that there is a shift to more real-time availability of evaluated pricing sources that are available on a real-time basis to help inform decision-making when markets are less liquid. And I think that's really critical in Asia credit, when sometimes we do see periods where, and we observe and they have feedback that on-screen prices can sometimes appear stale, and I think people really want to rely on a valuable, reliable composite price. So, in terms of the next stage, I think the innovation around availability of pricing data, how it's aggregated, how it's fed into models, and used, I think that's an area which will continue to develop in DM credit, but also we can pull Asia credit where it's less liquid along that journey with us as well.
Thanks, Harry. And maybe Phil, we could just turn that same question to you.
Thank you, Jay, and thanks for the introduction. Well, look, I mean, I echo to a large extent what Harry said. When you look at DM credit and how investors get pre-trade transparency, or how they get the data to make their decisions on how to trade and with which counterparties to trade, I'd like to push a little bit back on the narrative that investors in Asia are somewhat disadvantaged from the availability of the data. There are a lot of liquid bonds being traded in the region. Look at some of the IG bonds issued by Japanese entities, or Korea is a very active IG market. And yes, like in any other market, there are pockets of less liquid instruments where clearly price discovery is going to be a little bit more difficult. We have seen a significant shift onto platform, even in credit products in APAC over the last 11 years. I think on our platform, we're seeing 180 times X just from Hong Kong participants. And I think what is important for how we view it is always the platform. Yes, we do provide the pricing source, the pricing data, streaming prices, evaluated pricing. But then obviously, I think that unifies all of us in the room. What we then do is we translate that into the ability for investors to execute. And we provide the protocols. Well, we provide tools that help clients choose the appropriate dealer set for the appropriate product at that point in time. And then you have the execution protocols like request for quote, request for market, which is a two-way pricing mode, auto-ordering, portfolio trading, and rule-based automated trading.
So actually, when you talked about the growth of data and liquidity, I presume from that's happened, is this a recent phenomenon? Like, is this client driven that's causing it? Is there, and maybe I could turn to you afterwards as well on that topic.
Yeah, so I don't think it's not recent. We've seen continued growth over the last number of years, exactly as Adam mentioned. I think that there has been effort on integration to platforms. There's been effort to work on streamlining data and protocols. On the liquidity provision side, the availability of dealers on platforms increased. Confidence in the protocols that are available has also increased, and also the options that are available. We've seen on the credit side, in DM credit in particular, the impact portfolio trading's had. I'm sure we'll talk about that more throughout this session today, but yeah, I do agree entirely, Philip. We've seen exponential growth, and not just in smaller size traditional retail tickets, but also in more round lot, pushing towards in IG towards 10 million size trades and credit on platform, which is quite remarkable.
Okay, thanks for that. And for Soo Chin, I think FX is obviously a much larger global market. The transparency has been there for quite some time, especially when we think about things like Hong Kong dollar. CNH is a very large part of Asia volume. But there are pockets of illiquidity. There is local currencies. There's capital controls. I just wonder if you could talk a little bit about the current Asia landscape for FX.
Okay, so I think kind of FX is quite a different animal compared to credit and fixed income. Well, FX is well known for its fragmentation. The price discovery is pretty highly transparent in most of the G10 currency under normal conditions, including the majors like CNH and Hong Kong dollars. the regulatory reforms, especially on FX, since the 2008, and the automation has driven competitive pricing on machines. So it means that there's a high level of visibility in terms of like quotes and the market depth for CNH and the Hong Kong dollars even. Now, 60% of the market is now electronified, which means that 60% of this tick data available for analytics. Right now, we have seen explosive growth in FX volume for the 10-15 years. So what does the explosion of FX volume means for data? It actually means that data has exploded. And what does AI and machine learning fits on data? So if we combine the AI plus the data, we get pre-analytics available. And TCA, which used to be used on post-trade analysis, now combined with predictive analytics, gives us a very good pre-trade tools these days. So if we work with third-party vendors and some of the pre-trade tools. If you key in a 500 million euro right now, it can tell you whether it recommends you to tell you whether it should be done on an RFQ or algo. It tells you the estimated spread, slippage. It recommends you the LPs or even the time of the execution. So in terms of general, G10 is very good, but capital control currencies are quite different. So there's various different levels of transparency. Say, for example, India. Spot India is very actively traded on our platform. Now, Ringgit is almost zero electronification. It's almost 100% on voice broker. And then new kid on the block, Vietnamese dong. It doesn't even have voice broker in the market because by the time they come in, the market has already been proliferated in terms of like technology. So they use chat and they click and trade. So I think in terms of different levels of transparency, it differs in the whole APAC. And when it comes to the different segment of product, FX swap, even CNH, Hong Kong dollar, and Sing dollar, on interbank, they are heavily relying on voice brokers, which means that the curve formation relies on brokers' data rather than general electronic trading ticks. So I think the regulatory restrictions also kind of limits the cross-border formation. So I think in terms of like this kind of currency, it's kind of asymmetrical information and the price discovery is not as good. So if you are talking about pre-trade transparency on capital control currencies, I don't think we are far from being perfect because the data is very patchy at this moment.
So I think all three of you mentioned RFQ as a move on from, seeing prices on the screen to actually getting a firm quote to trade on. So maybe we can move on to the actual execution piece. And we've also touched on voice broker participation and the split. So maybe Harry, if we start with you on the, moving on to actual execution electronically, how much is getting done in, developed markets versus EM? What's the sort of, landscape you're seeing?
Well, I think as we discussed earlier, the number of tickets that are printing on platform now across all of the platforms that are available, and we see on Bloomberg, is that it is increasing dramatically. Like anywhere between estimates of like 60% of DM credit now is traded on a platform. And what's also remarkable on the DM side now is that an even higher percentage of those tickets are actually being priced by algos on the sell side. And what that's doing is that it's freeing up the time and the workflows to focus on those higher touch, harder to do illiquid trades where you do need to put more care, and not just illiquid in terms of the product, but potentially the size that you're looking to move, the risk that you're looking to move. So with respect to that voice segment of the market, there will always be, in my view, and I think it's commonly across the board people would agree, is that there will be elements where voice will remain very important. But there are things that we can do, and as you mentioned around analytics on the pre-trade side, where you can help the process. You can take the data that's available to help inform the traders the best way to execute, times to enter the market, potentially around dealer selection as well. So I think that in the existing electronic space today, which is already being somewhat automated, whether that's full end-to-end execution, automation, or parts of the workflow are being automated, I think that will continue to grow. We do see more clients come to the market looking to do more electronically to free up time to focus on generating alpha in those harder to do trades. And the standardization of those protocols, be that RFQ, all-to-all, or portfolio trading, provide a really kind of important backdrop to further developing other markets, which are potentially less liquid at the moment. So I think that whilst we see on the DM side very, very high execution rates, in high yield it's obviously slightly lower. When we go into Asia credit, it's slightly lower, but we do see growth in each area.
And maybe Philip, from the back, you turn that to you as well.
Well, I mean, Ari just made a perfect point of the benefits of electronic trading, right? Freeing up the execution traders' time to focus on the more, well, the blocks or the very illiquid parts of the market. And that's certainly true. I mean, what we have certainly observed is that, and that echoes what you said, that even products that maybe 10 years ago, people would have said, oh, this will never trade electronically, are now actively priced and traded on platforms. For example, local Asian currency interest rate derivatives. That's a development maybe over the last 5 years. They were all traded in voice. Now we have a substantial part of the market trading electronically, or regional government, like Singapore, here, Malay, Indon, right? They went electronically. And I think never say never. So to say that it's a progress, it's a process which we see continuing for sure. I mean, the latest that we are observing going electronic is repo, which again, a highly manual workflow, but platforms are bringing efficiencies to the execution desks and to the overall market, and thereby again increasing liquidity, bringing efficiency to the trading process. So it's an ongoing process. We don't see that stopping. And look, we're working very closely with the sell side on that, and it's a continuing development. So I'm sure when we're sitting here in a few years' time, we're going to look back at that and say, well, we would never expected certain products to be now in Asia, in APAC, traded fully electronically.
If this was getting recorded by AI, I would ask it to set a reminder for 2 years from now to come back and see where we have got to on this. But for FX, the BIS survey results came out quite recently, which showed just a touch under $10 trillion of volume per day.
Thanks to Donald Trump.
So yes, partly driven by politics, but also just by continued electronification. So maybe the same question for you, Jin.
Yeah. So I think, okay, since we are talking about the stats on BIS, so 70% of the FX spots now are driven by algo trading, right? And if we pick the stats like electronifications, it's about 60% in 2025 compared to 2022. So it's actually an indication that we are somehow plateauing in terms of electronification for FX, right? So what are the reasons behind? I think while vendors, we feel that the competition is intensifying, but I think that the product's differentiation has not been very pronounced. And the versions of technologies that we are using has not really shifted upwards in that sense. And obviously, we talked about it in the last time we were speaking, the fragmentation of technology stacks are still from back, front to front. It's like a kind of hindering the fast adoption of so many types of technology in that sense, right? So, and last but not least, FX volume, which is actually the bigger pie of the total FX market share, has not really grown on electronification because there's been a slow shift in the credit module solutions from very conservative to real-based model risk-based, real-time risk-based model, right? So this means that the 40% of voice trading is actually catered for large bespoke transaction that requires bilateral relationship for very illiquid currency and emerging market. And with, I think in the BIS, they spoke about the rise of curated liquidity, which means that why is there a rise in that? Because it provides customized spreads, bespoke tailored solutions, and of course, it's a screen counterparty. And then that brings us to the fact that there is a shift away from anonymous trading venue, which means like the primary trading venues like EBS and outside matching has seen a structural decline in that. The role of price discovery in the primary dealing has been challenged in that sense. I mean, over in our side, what we're trying to do is we are trying to work on some of the solutions because the legacy infrastructure made it less attractive to the API solution model base. So we work with third-party vendors for banks to publish the curve because before that it's just too manual. And now we are looking at hard credit solution for its matching as well. So if we take a look at what has happened in history on spot volume, when you introduce CLS, the volume proliferated. So I think with the hard credit solution coming in the near future, we might see that as a catalyst to change the whole behavior of FX swap trading. And then within the trading venues, I think the total SDP is handling clients' volume is still 50% higher than the multi-dealer platform. I think that's because we can have a lot of debate on that, but I think my colleague and I just agree that algo and API is the product differentiators that makes the difference. And I think on multi-dealer platforms, that's because the buy side are using it for price comparison, and there's been a growth of passive investment strategies. So these are programmatic and kind of predictable flows as executed by the buy side MTP. So I guess that's my observation of what's happening in the FX.
So maybe I'll pick up on your debate point there a bit, because FX has gone from very much a voice dealer to dealer direct, and then onto sort of all to all ECNs, and then one to maybe some on a sort of multi-bank platform, and then more curated, like people actually looking for, choosing their liquidity provider more carefully. Perhaps I could give a chance to answer a question first rather than
for the next question,
which is, just where you see that sort of cycle for, bonds, credit, like, what is the sort of direction of market structure? People looking, like, is it very competitive? Like, people are trying to go back to more bilateral relationships sometimes, where people, they have axes that oppose each other. What are you seeing?
It's a good one. I mean, look, again, it depends on the trade, right? It depends on the name that you want to execute, and it depends on the size. So axes are extremely important. I think the platforms are very good at condensing or displaying dealer axes in a manner that clients can easily look at them, evaluate them, and then use the platform to get the actual execution done. There are obviously other tools such as all-to-all trading, where you do not have that bilateral direct relationship of the client to the sell-side market maker. That also has a place in the execution. Again, where potentially the client doesn't want his name to be on the street, doesn't want the street to know that going in a certain direction. So again, it depends on the trade, right? I think highly liquid products, certainly you see hyper-competitive trading protocols being employed, like all-to-all larger liquidity provider groups being aggressed and ask for a competitive price. And then if the trade requires it, you will see a much more small footprint, bespoke, axe-driven trading approach. Again, That's all happening in APAC today on platform. And I think platforms are doing a great job supporting both avenues of execution.
Yeah, I think exactly. I think ultimately counterparties will meet and transact where it is the most effective way to do that. And effective can be defined in a number of ways based on exactly as Philip was mentioning the trade at hand. So on the technology side, whether that's from a trading venue, trading system platform, or an OMS system, EMS system, whatever it is, the role of the technology provider is to make sure those counterparties can transact as efficiently as possible to move the risk in the way they need to do. And just to pick up on, I think both of you mentioned it as well, the other consideration around when we talk about products that aren't as electronified as DM credit today or G10 rates, there's the platforms itself that generate and innovate around developments, but ultimately the market needs to move together in terms of liquidity provision, buy-side systems. There's no good creating, I can take an example, I was in a conversation with a client this morning around trading bond forwards. And from a technology standpoint, a platform could build an RFQ negotiation around that product, but unless the OMS system supports that and can model that, can price it, has the risk values, and same on the liquidity provision side, it's difficult to move forward. It's like, oh, I can transact on a venue and a platform, great, but now I need to manually book it in my system. So it's about just moving the market forward appropriately in the right products at the right time. And it's not so much the stars need to align. I think people need to be proactive on it and push where the most value is to be generated out of these workflows. So I think there are really good efforts in certain products to move them forward, but certainly technology just has such a vital role to play in that across multiple systems.
And this is where I have to mention FICC
Well,
as an enabler.
I'll tease you up.
Thank you. Yeah, I mean, the purpose of the fixed income committee is to take requests from market practitioners and standardize workflows, like, you know, the communication of those over FICC to enable people to have, you know, platform trading and, you know, to not have a lot of bespoke development done to enable these products. And, you know, FICC is an organization that really just tries to take market practitioners who we all have here in the room today and put them together to work out what standards are, because I don't think anybody's competitive edge is which, you know, tags you're using to communicate. It is, you know, the reach you have with clients, it is the LPs that you have, it is the product. Like,
I hope so.
Yes.
First.
And so at a base level, you know, we should be agreeing that standards, especially in a time of tech budgets are stretched or are all getting spent on AI, that we still need, you know, connectivity and new product support, and that grinds along in the background. And, you know, if people do want to join the FICC committee and, you know, put ideas forward for things that we should be working on, then, you know, my contacts on the FICC webpage, like the people here are all members. It's a good forum for making progress. And so I just, there was some mentions of TCA and pre-trade TCA, and we're sort of working through the trade life cycle a little bit. But I think it is worth talking a bit about post-trade TCA. You mentioned, you know, what is the most efficient way of doing things? There's a question of, you know, how are people measuring the quality of their execution on a platform? I mean, State Street has a product like BestX, which does what it says, but there's several rivals out there. There's also, there's also, you know, platforms out there as LP generated reports. You know, maybe we could just touch for the different products a bit on what you see in terms of TCA and how that's working.
So an area that we engage on the trading side, so within my group at Bloomberg, when it comes to TCA, so less, I would say, on a systematic basis where people are running their own reports, but we spend a lot of time with the buy side to help them understand the trading activity that they conduct over our systems, the impact that it has with respect to the number of dealers that they include in competition, the impact, what happens when they trade a portfolio in certain sizes, certain currencies, time of day. There are elements of data we capture and we make that available to clients to review. Certainly what we see more and more and more is that clients want more and more and more with the data that's available. So organizing that data, aggregating it and presenting it back to people is one thing. Clearly, customers want to look at the whole universe of their trading sets as well. So typically, it's great to look at the platform that you're trading on, but you want a holistic set of your voice activity as well. So embedding that all together and seeing how that comes out is really invaluable. So we certainly, when we sit down with the trading desks, every time there's an insight that is provided that people aren't aware of in the day-to-day trading, and it does have an impact because it affects change, whether that's a positive or a negative conversation with the counterparties. It certainly provides good insights and changes behavior for the better. So it's a really important part of the conversation that we have with our customers.
Look, pretty much the same thing on our end at Tradeweb. Clearly, our clients, they love going through their TCAs just the same as your clients do. But sort of not just repeating what you obviously outlined. What fascinates me is how nowadays clients are using it to tune the automatic execution rules which they have. Automatic execution has grown exponentially also in APAC across products. And obviously clients are very focused on it and want to make sure that based on data, they have their rules set up in a way when it comes to dealer selection, time of day when they trade, when they launch their trades into the market. And they're hungry for their TCA analyses. And I find it wonderful when you go there and you then see really the impact of that on their trading right away, especially on the automated side, which is a big deal for us.
And since you're on TCA, I know that you provide not only data to your clients, but also TCA to some of your LPs as well. Right. So they understand who they're trading with, you know, what their clients look like as well. I wonder if you could just touch on that a bit.
Yeah, well, we talked about the curated liquidity earlier, right? So we do provide liquidity management as like a value add to both the clients and the LPs, because the idea is to match the right set of liquidity providers to the right set of clients. Then that will be the best mutual beneficial outcomes, because you know, I don't want the clients to come in to say that, hey, this is a toxic client because I don't want to see his flow. So sometimes the access matches the different type of behavior. So this is what we try to do in order to reduce noise in terms of like LP clients relationships. And because sometimes the clients may not know what the LPs are good in which currency, because everyone tends to say that I'm good in everything, but there's only selected pairs of currencies which you excel in or have the best access compared to the market, right? So I think that's a good way to achieve the best outcome in terms of like maintaining a good both side relationship.
And moving further down the execution cycle onto post-trade reporting. So, I mean, obviously we've had Dodd-Frank from 2012, we had MiFID II. There is a lot more enforced transparency reporting on deals. There's, you know, generally the data is more publicly available than it has been. I would just wonder if you could talk a bit about that, and maybe I'll start with you, Philip, and then maybe talk about how that sort of relates to what you're seeing for Asia and specifically in Hong Kong.
Sure. I mean, post-trade transparency, I mean, it's the topic of the day, isn't it? Since on Monday, the UK transparency regime went live. We've seen a 6 times increase on our platform in real-time transparency compared to the previous week. Since the go live, and the implementation was also very smooth. So that's great. I think the next stop is going to be the transparency regime in the EU, and then obviously the market is looking forward to the introduction of the consolidated trade tapes, right, in the UK and in the EU, very similar to what we know from trace reporting. Look, I mean, there is no comparable regime in APAC to that at the moment. Now, and there are obviously discussions going on, and certain the regulators will be very focused on what's going on in other areas in other regions. As a platform, we understand that obviously that market participants will have arguments in favor and not so much in favor of increased transparency. That's natural. What we feel, we're an electronic execution platform. Transparency is in our DNA. So ultimately, we hold the belief that the introduction of a consolidated trade tape would certainly be of benefit also to market participants in the region in APAC.
Yeah, I think exactly that. And whilst there is, so there's no, the transparency is more diverse in Asia. And yes, there are, on the platform side, we mentioned there's dealer streams, runs, axes, evaluated pricing sources, composites that play its role. It's not quite the same as a trace for a direct observable price, which can feed into the growth of the market. What I would say, and I would advocate, I'm sure market participants are the same with regulators, if that were to change in the region, that there is, as early as possible, dialogue with market participants on the impact, actually doing data studies, getting feedback as early as possible. We certainly saw you mentioned the UK regime during the consultation period, what was presented wasn't the same as what was delivered, and that was based on very good feedback from both the buy side and the sell side. Similar in the EU, I think perhaps the regulators in the EU didn't take as much feedback on as the UK, but there certainly was a consultative approach, and that's really important because there is data available to help inform those decisions rather than being too aggressive upfront and potentially harming liquidity.
And it is interesting that a consolidated tape has gone live for fixed income. This has been an FX topic for a while,
but it hasn't gone live for fixed income yet.
Wow. Okay. But it's been agreed that it is going to go live.
Yeah.
I assume that it will. And that is a sort of regulator, push aspect. Whereas for FX, there was some commercial attempts to create one and have people contribute and for it to exist. However, those never really came to fruition. So I just wonder if you could,
So in terms of FX, the whole post-trade transparency, I think it's still an evolving landscape. The biggest difference between, like, just for FX itself, the difference between EMEA and US is that it applies to MiFID II spot FX. But when in APAC on FX, it's mostly primarily focused on derivatives. So FX, spot FX, and forwards is largely exempted on the non-restricted currency. So in the onshore markets that we operate, of course, there's mandatory reporting by the central banks, but it's all done by the banks themselves. So we don't really need to provide them the tools to do it on behalf of them. But I think the biggest challenge for APAC in terms of like this regulatory transparency lies with the differences in language. The data definition is not clear, not unified in the sense, like even assets is what? The few is 104 and MAS is 134. So we need people like you to fix it. And there's been a major rewrite from assets and MAS last year. I think Japan jumps in. This year is Korea and Hong Kong recently. So there is the path towards harmonization because they have a shared goal of practicing best practices, but the varying degree of building industry standard, I would say. So the reporting timeline also different across jurisdiction. So all this make the trading firms in APAC, the operational excellence, like the complexity is huge, right? You need a lot of credible reporting solutions to meet different rule books and evolving standards as well. So I would say that working with industry working group to understand and build towards a like fix is a good solution.
You've teed me up so perfectly. It's almost like I asked you to ask me this, which wasn't actually what happened. But there was actually, as part of the FICC FICC group, there was a central bank meeting or several meetings which were discussing harmonizing post-trade reporting using FICS. I'd say it made some decent progress. I think COVID came along and sort of made it harder to get together to discuss some of these things, and it maybe tapered off a bit. But I mean, I think that's something where, you know, it is good for people to get in contact with FICS about that, because once again, like, you know, post-trade reporting, very important, post-trade transparency, but also the amount of, you know, tech dollars that need to be spent to implement the, and, you know, typically banks are spending money on front office, you know, trading, execution, you know, algos, analytics, not so much money on, you know, downstream processing. It is something where if we can streamline that process, get consistency, then I think there's, you know, real industry advantages. If
I mean, the legacy structure has technological limitations, right?
So actually, we have a question, and I was going to remind people that questions are available if you want to type in the chat, which is there general demand for electronification of limit stop orders in FICC products? So, I mean, this is something which we've had for, at least in FX, for a very long time electronically, but
yeah,
I'm not so sure whether people are just, you know, getting quotes and, you know, hitting them for credit and bonds, whether people want to leave orders. Maybe you could.
So I would say on the credit side, there certainly is there are workflows available on the platform on Bloomberg where you can leave orders. I wouldn't say it's mainstream. It's covers a particular segment of the market for a particular moment in time. One area that is interesting, which is not the same but similar, is in the treasury space, where clients are able to interact with dealer algos, which is a relatively new phenomenon in the fixed income space. I know it's much more prevalent in FX and has been for a while. So I'm not sure if that answers the question, but that's kind of where we are on the Bloomberg side.
Similar for us, I mean, there is client demand for functionality on the platform where the platform monitors a composite price, and when a composite price is met, an RFQ is launched in its most basic form. So yes, absolutely, that's in the treasury market, and there's demand for it also in other classes.
Yeah, I think exactly that. So, like we see on the automation products that we offer and the other platforms offer, is around innovation around these types of workflows to achieve the outcome that you're looking to do. You might arrive at that outcome in a slightly different path, but yeah, absolutely the same as Philip mentioned.
Anything to add, Suchi?
Well, I think for us, we try to avoid having that, because I think if you trade FX, you understand that it's kind of contentious on the long tail of execution overnight orders where the stop loss and things. So we try to avoid having that kind of issues. So we're going to leave it to the good hands of banks to handle that in their platforms rather than on the vendor side.
And, you know, moving on to, I guess, like future thoughts. You know, we've talked a lot about international, you know, execution, like, you know, where things have gone in EMEA and the US, like thinking about, you know, what's maybe missing for Asia or Hong Kong, like direction that you see it going from your seat.
Well, the future of electronic trading, right? That was sort of what I got a few points to make. Well, look, there's a similar question there just on the screen, but to your point, Jay, what's missing from Hong Kong? Well, I wouldn't say that there's anything sort of missing at the moment, right? Obviously, the HKMA SFC came out with their white paper, laying out a path of what they're expecting to see in the Hong Kong market. Certainly from the trader position, we're looking forward to collaborating with the HKMA SFC on the basis of the white paper to understand how we can participate and how we can meet the requirements laid out there. Overall, on the future of electronic trading, that's a huge topic for us, obviously. I mean, and I'm just going to grab a few more minutes here. Now, obviously, I think we did a great snapshotting of where we are today, where we see sort of like markets getting more electronified. But what are the next steps? And I think for us, there are like two sort of big topics. One of them is obviously it's very buzzy. It's the whole digital ledger technology and AI. How do we bring that into electronic trading? At the moment, we see AI not as replacing the trader, rather augmenting the trader, right? Helping him to better understand the data, easier manipulate the data. On the digital ledger technology, we did some work there. We were quite active. We participated. There was a on-chain financing of a US Treasury transaction against USDC, so providing the instant settlement. So the whole settlement piece around blockchain. That's something that's very interesting for us and something where we are invested in participating in, that we also active in the repo transaction there. Another topic which is important to us at Trader is the whole breaking down of ciphers between asset classes. So, traditionally you have govies, swaps, credit, and they exist sort of next to each other. What we've done now is, well, why do we do that? Because most desks now is multi-asset execution desk, right? Those guys, they trade all products, right? And they want to have a familiar one. One example is portfolio trading. That was obviously launched into the US IG credit initially, that has translated into other credit markets. We have now brought that to the European government bond market, right? Just porting successful trading protocols across different asset classes. That's one thing. Or, for example, when you look at multi-asset packages like contingent and non-contingent swaps and government bond packages, right? These things sort of doing work along that, connecting markets, which we see as adjacent. So that's what we feel when you talk about the future of electronic trading. These are sort of topics that we're looking at. Obviously, working with the regulator, working with FICC, that's key to what we do here. But on that end, that's sort of something that we're really excited about.
Well, you can see cross-asset class in this room right now.
Yeah,
So,
no, I agree entirely on the cross-asset part. On the credit side, which is under my main purview, macro credit across cash products and derivatives. There's a vast area of improvements that technology and platforms can assist in that. So there are lots of opportunities, lots of trades that happen away from platforms today because they're not supported, and they're quite really high touch, and there's some execution risk because really you're trying to trade something contingent, but you're unable to. So bridging that gap between futures, options, ETFs, cash products, CDS, that's where I think that certainly is an area of focus for me and my team to bring forward. But just going back to the original in terms of the HKMA SFC side of the questions on the screen, I think to echo what everyone's saying, it's not as if we're starting from zero. The platforms, the technology that exists in the market today offers a wide variety of optionality and features. It's typically very well integrated to market participants. That can always improve across different products, whether that's a new product coming to the market or potentially a client's looking at trading something new. But really what I think the focus should be on is around the scalability of those systems, ensuring that they're robust, there's operational efficiency. It creates this environment of reliability, which you really want to have as a counterparty, that you're investing in a workflow that it's something that you can trust. And it also means that the liquidity providers will be available too, because I mentioned previously, you do need market participants and technology and regulators to move somewhat in unison to move things forward. People naturally aren't going to put their head above the parapet at the risk. Like, status quo is very comfortable.
Yes.
So I would say I would always encourage regulators for them to encourage participation to help move things forward in the electronic trading space.
Well, I think technological advances is like exponential. So I think with the help of AI, the market shift from intuitive trading to data-driven informed trading strategies will only go faster and intensify, right? So I think for me, there are 3 layers of NextGen. The first layer will be the NextGen trading platform, which Harry and Dr. Lim has already kind of described and have that concept. It will be like unified access to multi-assets. But for me, I think it should have an open set of APIs that can be integrated to clients and all kinds of platforms easily, because the next gen of traders probably going to be more quant-sized trained, and they will have better programming literacy than the current gen of traders. So it's going to be a different gen of traders that I envision. And now we talk about market volatilities. I think the new term is market velocities. If we look at what happened in April, it's a good illustration of market volatility plus market velocity. The whole price changes in terms like the changes in the price formation and changes in the speed of the drop and rise. You really need a lot of scalable, high performance, robust technology to manage that change. So it cannot be relying on simple models and brokers' data just to manage that, right? So, and then for me, the next gen of competitiveness is hinges on technological sophistication. So data plus technology is no longer optional; it is must. And then for me, the next gen of regional powerhouse trading hub is it requires regulatory support and infrastructure. So in terms of regulatory support, I'm looking for one that fosters innovation, not just looking at managing risk. They need to embrace disruption as much as advancement. So in the sense, the ultimate scenario of a next gen powerhouse is one that it will disregard asset class not more than just the operational excellence itself, right? So this is, I think, for me, the next gen looks like.
Unfortunately, the time is moving along very rapidly, but I see one question, maybe Zijin, if I could just squeeze this one in. In FX, there's technology constraints on post-trade data, legacy systems, fragmented reporting. If you had to prioritize, what constraints you would try and sort of alleviate in FX, then, what would be on your wish list?
For me, I think we mentioned that earlier. We need a common language, right? So the fragmentation on the tech stacks is something that we need to deal with. So we talk about it when there's a credit check. It needs to have this message: one means equals something, and that everybody commonly adopts it. That should be the first way to clear the path for post-trade transparency. And secondly, of course, we also mentioned earlier, I think the legacy infrastructure, that itself is a tech. If you don't move, somebody else is moving, then it's not all moving together. So there needs to be this whole common mindset to change that in order for us to reach the common path in terms of post-trade transparency. That would be my top 2 if I was a CEO.
if I could just grab any final thoughts from Harry or Philip.
I think just to kind of repeat what we said, there's huge value in existing protocols that exist today. They continue to improve as adoption continues, because almost by definition, you get feedback as people embrace electronic trading, whether that's automation or private trading, credit side as well. So I think that we've got an incredibly good foundation. It's been evidenced across rates and credit products, EM as well. And I would just continue to have participants just engage in the conversation with industry standard bodies, platforms, and counterparties on the topic, just to see where we can remove frictions to improve client outcomes.
Yeah.
Yeah, no, look, I think we are at an exciting stage of the development of the electronic trading universe. The systems are robust, they're proven and tested, they've been out there now for several decades. Now we got also technology coming in, we got the regulatory landscape moving forward. I think it's an exciting point in time for the industry, and by extension for the market participants, right? Because as you spoke about velocity, exactly. I mean, things will just continue to develop and at increased speed, and who will benefit? Well, it's going to be the overall market, it's going to be the investor base, it's going to be easier and better to transfer risk. And that's what I think all four of us here are basically invested in. Yeah.
So yeah, I think we're pretty much at the end of the slot. I'd like to thank your participation today. I think it's been a great chat.
Thank you.
Spontaneously put together for this, and maybe Ed is right that we could do something else in the future for attendees. You know, put your feedback in, what you'd like to hear from. Certainly, I learned some things today. Hopefully, the 45 people who joined also did. And this added some value. And I just close by saying, yeah, thanks a lot for your time. And yeah, please get in contact with FICC or the people here about your electronic trading needs. So
Thank you.
Thank you.
Thank you.
Thank you, Jake.